Hey, Renter Retires, it's Adam Schroeder here with another episode, and I am once again joined by the founder of Renter Retirement, Zach Lemaster himself. And today we have a very exciting topic that is, I believe, on the tip of everybody's tongue if we want to talk about economics and what's going on in the market, and that is mortgage rates and inflation and GDP growth. And these are things I think, Zach, that we can safely say every single investor is talking to us about.
We hear it every day, Adam. This is a concern for everyone. We're seeing it right now. Interest rates are rising. How long are they going to continue to rise? When are we, at what point will they stabilize? How does this affect my investments? I mean, that's a big thing. I think we've been a little bit spoiled over the past couple of years to be in this, this all-time low interest rate. And really, big picture, and part of the point we're making today is a simple fact that interest rates still are at all-time lows. Yes, it's a factor that may influence cash flow a little bit, but it's something we need to be aware of. And interest rates are just one metric at one point in time. Yet you can lock in a 30-year fixed loan at that interest rate, but you got to look at the overall picture of the investment to see how is an interest rate actually influencing cash flow and what else is actually happening out there. I mean, a few investors we've actually heard have decided to not buy properties because they're concerned about raising interest rates, even at half a point or a point higher. They've said, I don't know. I mean, that's really, I think, a very closed mindset because there's other things happening in the economy right now that are more important than raising interest rates and that are tied into interest rates that we need to be aware of. Inflation is another key point we're going to be talking about today. As we know, the Feds try to mitigate inflation by influencing interest rates. So when we start to see super aggressive inflation, which we're seeing right now, make no mistake, and like we're going to see in the future because of all the money that the government has printed and injected into the economy, we're going to see interest rates rising rapidly to try to mitigate that inflation. And so, I mean, it's kind of something we need to look at to determine why are we investing in real estate in the first place. People that are looking at interest rates are looking at the cash flow analysis. The bigger picture, in my opinion, Adam, is more importantly what's happening on a global economic scale with inflation. Inflation is a tool and can be used to your advantage when you have hard assets, or it can work against you when you just have money that's being devalued over time. Real estate is one of the best places to put money for inflation because it's actually working for you, causing the market to appreciate, causing rents to increase over time. That's growing your net worth and your income over time. So don't be so short-sighted looking at just the interest rates rising. But let's focus a little bit more on interest rates right now. Maybe we can look at an overall historic picture to kind of paint a more accurate setting of where we're at historically with interest rates. What do you think?
Yeah, and I want to say the people who are referring to this the most when it comes to interest rates are the people who are looking at the new construction stuff saying, I don't know what the rates are going to be like in, a year or, 12 months, 14 months, something like that. What is my interest rate going to be? And one of the things I just want to point out before we get to this picture is the Fed has come out and kind of told us what their roadmap is. If you think that the market hasn't priced that in already, then I think you're gravely mistaken. I mean, they're not going to say, we're going to raise it the next 4 meetings, and the market's going to say, okay, well, then we'll bump it up a little now, a little bit later, a little bit later, a little bit later. It's built in at this point. The only thing that's going to cause it to really increase is if the Fed then comes out and says, actually, it's not going to be the next 4 meetings. It's going to be the next 8 meetings. It's going to be the next 9 meetings. That will cause it to jump up. But until they change their saying, I mean, people are expecting these things to happen. And the Fed has been pretty darn consistent with doing what they say under Powell. And so the interest rates are already reflecting what they're expecting to happen with the Fed. So just want to throw that out there before we dive into this. But this is a historical chart going back to around 1970, I believe. And this is pretty, you can't see the exact numbers in a lot of these, but you'll note that up here in the early 80s, that's really high. As you come
17
down.
17.5%. Yeah. I mean, some people remember those type of interest rates And at that point in time, the norm, right? But that is astronomical. That is crazy.
Yeah, I mean, you think about that, the people who did that, they would have just paid off their 30-year mortgage less than a decade or right around a decade ago. So I mean, it's it's serious business, and they've probably refinanced, so they probably haven't paid off their home if they're still living there. So as it continues down and down and down and down, we rarely see blips longer than a year, 2 years at most. And then we bottomed out here in the COVID years, where it got down to what, 2.5% or so, some ludicrous number. I think some people were locking in their primary rates at like 2.25 at one point. And so I mean, these are obviously owner occupied, because finding investment rates is near impossible. But you're still looking at owner occupieds in the 4% range right now, 3.5, 4%, which is ludicrous.
I mean, big picture, what this shows me, Adam, is that we still have all-time low interest rates, and interest rates will continue to rise over time. They have to. They have to keep up with inflation to, try to have some sort of control over that. And so, still, when I'm looking at taking out financing on a property, maybe I need to put a little bit more money down. Do I pay a little bit of points, to actually buy that rate down? I mean, I typically never do that. But for me, when I'm evaluating properties, this is just part of the game. Interest rates, big picture, are still all-time lows, and I actually am more motivated right now as we start to see rates climb slowly over time. That I actually want to secure more debt now. I'm not looking back 6 to 12 months to say, okay, maybe I could have, those times are over, and I can't get that same low interest rate at 3.5 or whatever on an investment property. Now I'm 4.5, 5. I mean, that's still very low and still very achievable for cash flow. That's still something I want to lock in, because I know for a fact over time interest rates have to go up more than where we're at right now. It's when we talk with some newer investors and people, I mean, it's interesting. We can look back and reflect over the past few years to see, just based on people's opinions on what becomes the norm and the standard. And most people are not looking at a full scope of where interest rates have gone and where they're likely going to go. And I think this is important to conceptualize. Yes, they're rising. That points to strong economic factors. We're going to talk about GDP in a second, but that's even more important that, hey, this is still a good time to secure long-term debt, especially as we're seeing inflation skyrocket. That money's being devalued over time, so you're paying that money back with, that lender back with, in future dollars, less than you're borrowing if you hold that loan long enough. That's why it's important still to factor in keeping debt on your balance sheet, good debt, and taking out these loans at the interest rates we're seeing today.
Yeah, and I always think to myself, and I've told some people this, that interest rate isn't that important. Just look at your payment and make sure your property is still going to perform well. I mean, it's just one metric that impacts one number on your spreadsheet. That's really all that it does, is it impacts the principal and interest payment that you're going to do. So as long as that number is low enough that you can still cash flow and cash flow well and get a good return on your investment, who cares what the number is? Realistically, when you're starting, I mean, if it's really low, then you'll have a low payment and you will have issues mentally in the future doing a cash out refi if it means your interest rate's going to go up. If it's really high, then as rates then drop, I mean, it's rates are going to fluctuate. They're going to go up, they're going to go down. Eventually they'll probably be back in the mid low fours. Maybe that's a couple years off, who knows. But whenever they drop back down and you've got equity, well, then you just do a cash out refinance and get the money out that way. But in reality, it really only impacts one number in your grand scheme of your spreadsheet for your property. So yes, it's the number everybody looks at, but it's not the end all be all of your numbers.
And that's a constant, right? When you're securing a 30-year fixed mortgage, that payment doesn't change. But what does change over time is the rents will go up. Also, what we're seeing with inflation is the rents are dramatically increasing, especially if you're in the path of progress, investing in areas where there's strong rental demand and a population shift. The Sun Belt, for example, and some of the areas that we focus on, those rents are increasing. We saw over 18 to 20% in 1 year. And so that's important to consider big picture, that a cash flow. Yes, we want all properties to be cash flow positive. We would never encourage someone to buy something that isn't cash flow positive today. Over time, though, your mortgage is a constant number in payment, and your rents will continue to increase over time. And so your cash flow will get better over time. Plus, you're growing equity through appreciation and debt reduction. But let's take a look at some of the inflation that we've seen historically, Adam.
Yeah, so this is the consumer price index for all urban consumers. You'll see the blue line is basically what we want to look at here because that's the one that doesn't strip out food and energy because you always got to factor in consumer price inflation because nobody eats or uses electricity. So you clearly want to use that one. But if you look at the blue line, I mean, we're right now at around 7.5% consumer price index, which granted is the highest it's been since, if you look here, the 83, 84, maybe 82, somewhere in that range. So in that regard, it is significant. I mean, and if you look at where we were back in beginning of COVID, it's a lot higher than it was back then. That is very true. It's undeniable. I don't know anybody who will talk to you and say there is no inflation going on right now. So historically, probably slightly higher than average, but nothing ludicrous.
I mean, this is something that's less tangible. It's like, how do we actually quantify inflation? I mean, obviously, there's certain metrics that are used in government analysis like this, but it's something in our daily life. Like, how do we actually look at the goods and services that we're consuming to see how do we realize an inflation? I mean, I think Sam did the example of a gallon of milk 10 years ago was like a quarter of the cost it is now or something like that. I mean, those are kind of unique examples, but this is something that tends to creep up on us over time. It's like, okay, prices are going up, gas is going up. This causes a devaluation in our capital, right? So what this means to me is that I want to have my money invested where inflation can be used as a tool, and I'm not just letting it sit in the bank, letting inflation chip away at me. There's no doubt about it that taxes and other things are going to continue to increase over time. I don't think this inflation graph is going to get any better or prettier over time. I mean, if you just look at what happened with throughout the COVID period, with how much money was actually injected to the economy, that sometimes that takes a year or two to actually showcase in the inflation numbers, and takes a little bit of time to actually play out. So again, going back to the point, you need to have assets that are going to be outpacing inflation. We absolutely know that real estate will do that in a number of factors, not only from rents, appreciation, but also using leverage. I think leverage is actually taking out debt, especially when we couple this with the last graph that we looked at, it having all-time low interest rates, where you can secure long-term debt at low interest rates. It doesn't matter if it's 3%, 5%, even 6% is relatively low. The simple fact is, at the rate of inflation, you're still coming out on top, regardless of that interest rate, simply because you're borrowing money at today's dollar value, which will be devalued over the years. I mean, we did that interview with Aaron Chapman where he talked about, the if you actually held a loan for 30 years, you would be paying less back than what you borrowed with future valuations. It doesn't make sense for banks. There's no way banks would come out on top, and that's why they front load interest, and that's why they encourage you to refi so
Yep.
often. And it's important to know too, a 30-year fixed loan. I don't know where anywhere else in the country. We invest in other countries. My wife's Canadian. We have properties in Canada. There's no such thing as a 30-year fixed mortgage interest rates. And when you get into the commercial space too, there's no such thing as a 30-year fixed product. Sometimes on multifamily, you can look at things like that, depending on the size and the loan parameters. But generally speaking, the loan is a 5, 7, 10-year term, possibly. It can be amortized over 25 or 30 years. But it's kind of a risk for banks to lock in an interest rate at 30 years. We're the only country that I'm aware of that has that as a loan product for 1 to 4 units that's available. And because of that, it can be a very valuable tool.
Yeah, I remember when we were in Belize just a little while back. I talked with a lot of people there about real estate because I'm a nerd, and the guy who showed us through the Mayan cave was talking about people's homes and how they slowly built them over the years. Like they started with a small house and then they added to it and added to it. And I asked him about mortgages, and do you know what their mortgage? Take a guess what their mortgage rate was in Belize.
I have no idea, Adam. Let's hear it.
About 13%. I told him at the
13%.
time we were, it's like, for your own home, you can get a 30-year for about 3.5%. And he about had his eyes come out of his head when he heard what what you could do in the U.S. With your primary residence. I mean, it's really a unique thing. And when you were talking about interest rates and inflation, I mean, you can essentially do inflation arbitrage here because if you can get debt for 5% and you're being, paid off essentially at 7%, I mean, even if it just happens for 2, 3 years, you're in the driver's seat because then, even if inflation, I mean, the Fed has flat out come out and said their target rate is 2%, which when are they going to actually hit 2% again? Who knows? But even if the target rate is 2%, if you've got a 5% interest rate, your spread's only 3% there. So, you can increase your rent by that much easily every year and cover the any gap that might actually be happening. So, when you look at the ability of you to kind of do that with your loan, since it's fixed, you're in the driver's seat. I mean, you really are.
Inflation arbitrage. I love it. Coined by Adam. But you
I'm
brought up
sure
a lot of
somebody else has said it, but
no,
I'm
that's a
calling
lot
it.
of good points. And we all know that the Fed rate doesn't equally mean, like, 2% does not mean equally mean interest rates at 2%. The mortgage interest rates are different than those and can be much higher, but it kind of gives a baseline to where interest rates should be. I think having a global view over just kind of the opportunity in the States, and we see this all the time because we work with many international investors, people that are investing their money in the States for a reason. I always love talking with Australian investors, and I never heard of the term negative gearing until we talked to some Australian investors. And there's some places where they don't obviously have the lending available on this 30-year fixed loan, but also just the real estate. They have these huge raises, these huge rises in prices, and then these huge crashes, and that's just normal. And it's crazy to look back because the U.S. has so many different micro economies. Everyone looks back at 2008 as kind of this, okay, that's the baseline for a recession. Well, or for a real estate correction. It's actually not. That's just the worst real estate correction we've seen. And that's what everyone remembers. We've had 2 corrections since then, but no one blinks an eye at those. But I mean, 2008 obviously is a completely different scenario with different lending available. But there's a lot of places in the world where you can't even positively cash flow. People actually buy negatively cash flowing properties to offset their income. And I think the U.S. even has more beneficial tax plays and tax benefits to own real estate long term. So we're kind of going off on a little bit of tangents here, but the point is that where are we headed? We know that interest rates are going up. We have a thriving economy. The real estate economy has just been, or the real estate market nationwide has just been going crazy. I mean, basically everywhere is appreciating. I'm sure there'll be some stabilization over time. I don't think interest rates are going to affect that dramatically. And if they are, it's probably going to be the more expensive properties, the luxury type of housing where, yes, if interest rates could make, 1 point on an interest correction could make a big difference on a $2-3 million house. On a $200,000 house in the Midwest that's yielding a 15% cash on cash return, maybe it's now a 14 or 13% cash on cash return. It's changing your mortgage, maybe $40 a month. It still makes sense. And it's still important to be investing in these type of asset classes so inflation in the future can be a tool for you to mitigate this exposure. But I think you want to talk a little bit about GDP and kind of like where we're at economically as well, right, Adam?
Yeah, because when you look at the inflation rate and see that it's going up, it's important that we don't have a stagnant economy because that's really stagflation is probably the worst thing that could hit us. Anybody who was alive back whenever it was going on knows that it's not an easy thing to get out of. And so the question really is the economy continuing to heat up? Because as inflation hits and as people's wages go up and as things get more expensive, hopefully we are producing more and being a better economy. And you can see here, this is the real GDP percentage growth over time. And I mean, for a while, you'll see here, I mean, getting over 2.5% since about 2008 has been hard. I mean, we've been chugging along. I mean, a 3% GDP growth is a good solid growth for an established economy. You get up into the 4%, you're doing really well. Well, we are currently over 5% at the end of, I believe this goes into the end of 2021. We obviously don't have any numbers on the 2022 GDP yet, but at the end of 2021, we were looking at, 5.5 or so percent growth GDP. So the good news is we are seeing rates go up, yes. We are seeing inflation go up, yes. But we are also seeing our GDP increase. So we are not staying stagnant on the GDP front. So we do not have the same concerns that we had the last time we had the high spike in interest rates and the high spike in inflation.
It's a different world, a different economy, different circumstances, of course, but I think we're projected for continual economic growth as a country, as a whole. I think the real estate market will continue as well. Will interest rates increasing have a little bit of an influence on that? Yes, in certain sectors of the real estate market, but I mean, we should have looked at population growth as well. And I know you talked about new housing, and how there's a housing deficit. So when you look at that as well, especially in areas that have high population growth, there's an extreme housing deficit. Simple supply and demand will tell you that rents and home prices will continue to increase over time,
Yeah.
likely as a whole, but also, in certain areas more so.
Yeah, and I mean, population growth in the U.S. last year was not pretty. It was like a 0.1%, but obviously we had people moving around inside the country, and that was pretty for the places that we were or that we are. So you got to you got to make sure you're looking. And this is an important thing that I touched on one of my YouTube videos, but it's important for people to look at as well. And that is when it comes to population, it is important that you don't just look at the population of the city. I gave the example of Birmingham because I've looked at Birmingham's demographics not too long ago. And if you just look at the population of Birmingham, it's decreasing. And obviously, you don't want to be in a city that the population is going away. But then, if you look at the suburbs of Birmingham, I think Birmingham decreased like maybe 10,000 from census to census. But if you look at the individual suburbs, those went up 30,000, 20,000, 40,000 in some. So the area itself blew up, but the inner core decreased. So it's important as you're looking at the demographics and looking at where people are moving and getting in the path of progress, like Zach was talking about, that you don't just look at the internal city, look at the surrounding areas, because that is really where people have been moving over the years. So don't just look at your urban core and see what's going on there. Expand it to 45-minute drive, hour drive to the city, because people are willing to do that, especially now that we've had a pandemic.
Oh, yeah, that's very important, Adam, because we've seen that in the areas that we focus on, some of the best opportunity. We're seeing higher demand for people that are still in, commute distance to a large metropolitan area, but in an area where they can actually have their space, live and work from home. They're not, having to live on top of each other, and people are liking their space. They're moving around the country and still working remotely. So there's a lot of opportunity in those secondary and tertiary markets where those price points aren't going to be astronomical, and you can get a good solid tenant in there that's going to be family oriented and really, probably stay for multiple years. But just to kind of summarize what we're talking about right now, interest rates are rising. There's no question about that. I think they will continue. It's not as daunting as it may seem when you just hear the news. Really, you need to evaluate the interest rate on each individual property. Interest rates are still at all-time historic lows, albeit they've went up slightly over time, and that will continue. Inflation and the GDP is very, very strong over this past couple of years, and it's going to likely increase even more so over the next few years. And that's why it's important to not have your money just sitting in the bank. It's important to make sound investments, educated investments, and really know how to use inflation as a tool. Real estate, obviously, we're biased here with real estate. Real estate is an exceptional tool to be able to use inflation to your advantage, to allow that to increase home prices, to allow your rents to go up over time, to keep the actual value and outpace inflation. So then you can get ahead of the inflation number. But you couple that with using long-term debt at a reasonable interest rate that can allow you to cash flow, and then also have that debt be paid back over time at the future valuation of dollars, but borrowed at today's dollar. I mean, that just creates a recipe for wealth generations, for wealth building for future generations for years to come. So that's why we think it's important to continually invest in real estate.
Yeah, and one thing I want to touch on before we wrap it up here is I have been watching forecasts for real estate, and they keep getting better and better and better. Everybody's favorite, Zillow, and we know that their Zestimator was a flop, but they, at the end of 2021, came out and said they expected housing to go up. I think it was 11 or 12% nationwide in 2022. They have since revised that number twice, and they have come out and said that they expect appreciation in the country to be 22%, I believe it was, in 2022. And even if they are 50% wrong, that is still an 11% gain across the country. So, if you're looking at, if you're looking at buying a property today at 5% versus buying a property that's 11% more expensive next year, but maybe at 4.5%, it doesn't really equate. There's no real point in waiting that time, even if interest rates do drop down to 4.5%, because your baseline price is going to be higher. And so your mortgage payment will probably end up being a wash, except you just now lost out on the equity buildup that would have happened if you'd gotten in at the 5% mark.
Oh yeah, we don't want to play the interest rate gambling game where it's that's not the reason to purchase or invest. Obviously, it's something to be conscious of, and as you mentioned, an important factor when you're evaluating cash flow. But I mean, yeah, you wait 6 months. That's 6 months of cash flow, 6 months of appreciation, 6 months of debt reduction, 6 months of tax benefits, and depreciation you could have utilized that will far outweigh 0.5% of an interest rate. So, but I'm going to hold you to that, Adam. Let's do it 1 year from now. Let's look back and see if in 2022 we had 22% appreciation.
Well, that's Zillow, not me. I think we're going to have a good appreciation, but I don't think. I mean, I think Zillow's kind of out of their mind when it comes to 22%. But we'll, I guess we'll have to wait a year and come back and see what actually happened. But I have my sincere doubts about that. I don't think we're going to see another COVID-like boom, but I don't see it slowing down much.
Markets appreciating. There's no question about it. Some markets I think will far exceed 22%, and some markets, probably won't meet that. But obviously we want to be in the areas in the path of progress. So.
Absolutely. Well, Zach, thanks for joining us today. To all of our listeners, head on over to renttoretirement.com. You can check us out. You can see our inventory. You can schedule a call with us. We're happy to talk with you about your plan, your way to get in progress. If you need anybody to join your real estate team, we can connect you with them. Also, we'd really appreciate you going over to your podcast platform and leaving us a review. It greatly helps us. And if you have any questions, email us podcast@renttoretirement.com. That's podcast@renttoretirement.com. Or if you have any topics you want us to cover, you can email us there as well. Really appreciate you taking the time to educate yourself. Again, check us out at renttoretirement.com, and we'll see you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.